Good. Well, first of all, after buy and build strategies, we're now going to move into sector funds. There's one person missing, but as we have a timekeeping issue, we'll get started straight away. So then maybe you would already like to start introducing the participants and set out the scene. Thank you.
Yes, and hello and welcome to everybody. Expect this to be an exciting panel, so give me energy, please, today. That will be useful. And obviously, to begin this panel, I'm Denaim Sandhu from HP Growth, but the center of attention today is obviously with our panelists here. So I'm going to start off by asking each of them to introduce themselves and briefly, please, so name, surname, where you're coming from, organization. And one special question to always break the tension, which is, if you were a French cheese, which one would you be and why? So, I'm passing over to you, Pierre.
Yes, hello everyone. I'm Pierre Stadler. I'm with Pictet Alternative Advisors. I'm head of thematic private equity there, based in Geneva. And if I would be a French cheese, I would be Swiss cheese. Since I'm from Switzerland, I'd be a Gruyere cheese. So.
Well, that was an easy one.
Hi everyone, Cameron Payne from Hermes GPE, co-heading our European investing activities across funds and co-invest. If I was a French cheese, it would probably be Brie, just steady and reliable.
Steady and reliable, okay.
I'm Sascha Lilic. I'm a managing partner at SHS. We are a dedicated healthcare specialist fund based in Germany. And I would be probably a Roquefort. Because we have aged. We have been around for 30 years and have the experience and relationships from those 30 years.
Okay, so we've got aged cheese, steady, and Swiss. Okay, which is fantastic. So let's give some context to our discussion today. According to Cambridge Associates, sector-specialized funds have always outperformed generous funds. We see that, and we've seen many studies that indicate that. And so just to set a bit of the scene around that, I'm going to throw my first question to Cameron and Pierre, which is, why are we seeing a bit of better performance around sector funds versus generous funds? And what's your opinion on that?
Sure, I think the benefits of specialization are fairly well known. I think many of these funds have built extensive networks and kind of unique origination angles, which are allowing them to access probably the highest quality deals within their vertical. Beyond that as well, I think we've generally seen that they have a pretty strong playbook as to how they create value. So we're seeing these managers sort of access the best quality deals within their sector and then typically deliver more value and deliver value quickly. And so that's sort of where we're seeing today, at least, the outperformance.
Yeah. Okay. Well, we have our fourth panelist just joining us. Hello, welcome. Please, could you introduce yourself, name, surname, where you're from, and if you were French cheese, which one would you be and why?
So hi, sorry for being late. There was a mix-up in my calendar. I was not eating cheese anywhere. So I'm Paul Mizraim, one of the founding partners of Blackfin Capital Partners. We are a sector specialist investing in financial services across Europe. And if I were a cheese, I wouldn't be cheese. I don't eat cheese. I don't like cheese. Sorry.
So we have no cheese, Swiss, steady and reliable, and the last one was old and aged. Great. So we just started off with our first question. I want to dig deeper on what you just mentioned there in terms of sector funds being able to source quite better and quite precisely. Pierre, have you seen that across the funds that you've looked at?
Yeah, I think I can confirm what Cameron mentioned on the building of network and the depth of the expertise that we can see at sector funds. But I think one thing I would add is the access, certainly for companies in specific areas. They're certainly more willing to transact and to collaborate and to partner with people that speak the same language and with whom they can relate directly on business matters. So I think it gives sector-focused fund an advantage on deal sourcing as well.
Yeah, and I would also like to pose the same question to you as well.
So the way we source deal is we spend a lot of time on the ground engaging with owners, managers, financial institutions, and talking about the business opportunities, competition, new products, new technologies. And so this being able to have this common language, as you just said, is essential in the sourcing. It takes longer. Doesn't mean necessarily you're talking about an actual transaction, but you create relationships, you create a network in the industry, and then over time that ends up being creating investment opportunities.
Sas, is that the same for you because you're more on the health tech specialization? Would you say that's similar for you?
Yeah, it's about the same. I mean, what we do is in management presentations, when we ask questions and discuss with the owners or selling shareholders, we always get the feedback that with us, it's more of a workshop really style that we do than really some type of interactive question. More than they are educating us about the market. It's more about strategizing, about operational topics where you can actually tackle them and how. That's one thing. And then also, I think it's also helpful internally if you decide upon deals. If you're a sector agnostic fund, so to speak, and you have maybe you're coming with a healthcare deal and you have to explain to everyone else what the healthcare deal is actually about, inflection points and how long it takes and how much you have to invest into and why that's important, is obviously easier if everyone else understands what that actually is. So that's also helpful internally as well, on top of externally.
So I wanted to actually ask a question to you, Pierre. Do you think that stage specialization also has something to do with the performance that we're seeing? Or is it purely about sectors?
I think it's always difficult to interpret private equity data in general. The way you hash it is, I mean, there's not sufficient data to draw some very clear conclusions. We tend to have an approach that's agnostic across stages, where we select funds in all different stages. And I think what I would say is that there are extremely good performers at every stage. So the selection matters at every different stage. But again, I think the way you hash the data is certainly or can confirm or infirm a point or not.
Okay. Would you say it's the same for you? Anyone else want to add to that?
Yeah, I think we have, for example, done a small evolution of our strategy before. We have invested into pre-revenue companies and fast-growing companies. And if you're doing that, then the capabilities you need to bring to the table are really totally different.
Right.
The value add you're providing is really totally different. And if we're now specializing only on fast-growing companies, helping them to scale further. And that is great. I mean, learnings you can provide from one portfolio company to the other. And learn, including within your portfolio as well, that they actually teach each other best practices. That is very, very helpful, I can say. I think, at least from my point of view.
Okay, so you would just say basically there are some differences if we're looking at particular stages within that, and would you then advocate more for hyper specialization? You know, so if it's sector and stage and just really fine tuning.
Well, if you have enough deal flow in that if that segment, then yes. Because I mean, again, if you have sufficient deal flow of attractive deals, then the more you specialize, I would say, the better it is. But then again, you have to be aware of, do you have enough attractive deal flow? That's basically the trade-off.
Yeah, and Cameron, you are investing quite across the board. So how would you see it from your perspective?
Yeah, so we are very mid-market orientated, which we're typically defining as trying to take exposure to businesses through fund structures that have EVs typically below 500 million or even below 250 million. We're investing globally. And so I'd say from a US perspective, we're backing a lot of what you'd call the hyper-specialized funds right now. So people who might be just purely doing education technology. I think in a market like the US, which is so deep, then clearly, to Sasha's point, there's sufficient deal flow to deliver on that strategy. I think in Europe, we haven't quite gone that hyper-specialist. And by the same token, I don't think the market is at the stage of the US where you have a lot of hyper-specialized strategies. But we're probably deploying 2/3 to sort of 75% of our fund capital into specialist strategies now. And to the earlier point, I think we like to see that marriage of sector specialism and stage specialism. We do think there are very unique challenges investing at each point in a company's life cycle. And similarly, the engagement model with that business is quite different if you're working with a founder owner, say, as opposed to a very senior, well-tenured CEO.
Okay, yeah, that's pretty impressive. And this is a question for everybody here. Do we think there are particular sectors that are just versed at providing returns? Do you think we would see the same if we were, investing specifically in industrial versus investing in fintech alone? And so do we see that there are particular sectors, particularly that weather the storm a lot better? So I'll start from this point all the way down, so you can start.
Obviously, financial services is the best place to invest. It's also the most complicated, so that's where you need to have specialists. I think in the current environment, the financial services is a little bit immune. This is one of the first crises where it's not the banker's fault, so it's kind of nice not to be the bad guys in the current environment. And so I think actually financial services is proving to be an attractive sector at the moment.
Okay, so we've got financial services here.
I would say it really depends on the cycle. Cycles can hit different sectors differently. So I think the stance we are taking at Pictet is more of a thematic point of view, which can encompass several sectors, but which is not as prone as to cycles as a specific sector would be.
Okay, so from a more cyclical way of looking at it.
Yeah, I mean, at Hermes, we're also taking a thematic approach, but obviously we're expressing that through a sector orientation. I think to your point, clearly not all sectors are built equal.
Yeah.
There is an opportunity to, we think, invest very profitably in most sectors. But I think to Pierre's point, obviously, I think where we've seen sector funds come unstuck is where they're taking on a high degree of cycle risk, operational complexity, or regulatory risk. So I think when we think about it, you need to be fairly granular within your sector as well. So I think, Paul, in financial services, I think 10 years ago, you would have probably seen quite a few investors who were very focused on the balance sheet side of financial services struggling. But then similarly within financial services, those more on the distribution, asset management side, have been very successful. So long-winded way of saying, yeah, we see a big difference between sectors, and clearly we have a preference for sectors that don't have some of the risk factors we just discussed. But even then, within each sector, we think you have to have a fairly granular view as where you want to play, because it's not necessarily the case that the sort of rising tide lifts all ships.
Yes.
Yeah, and I would like to confirm what Paul said, but I can't, unfortunately, because healthcare obviously is the best sector to invest in. But I mean, for example, I would echo definitely the more complicated and complex a sector is to understand, the better it is to specialize, to work with a specialist in that segment. And I think, for example, healthcare is a very complicated segment to understand the patent protection, the regulatory aspects, the stakeholders, and so on and so forth. That's extremely important to understand. We're non-cyclical, basically, so we are probably never the best sector to be invested in. We're always a very good sector to be invested in, and that is probably the beauty of healthcare.
Wow, okay. So I have a feeling here this panel really loves sector specialization, but I would like to get some cons of sector specialization so we don't have too much propaganda in this room. So I will start this way again. The cons.
So I'm not going to give a con, sorry. But I think one of the challenges of being a sector specialist is as you're more expert in a sector, you are prepared to address more complexity, to look at more difficult situations, more complex situations. And I think the main challenge of being a sector specialist is not so much the sourcing, because we have this huge advantage, and I think we all share the same view, but it's more how to price the complexity. Because if you take on more complexity, but at the same price as any deal, then you're not really creating value. And I think the big challenge or con or difficulty in sector specialization is to really get a proper pricing for the additional complexity that you're taking on. And so typically we try to get at least 2 rounds of EBITDA multiple below market prices for the complexity that we address. But I think this is really the challenge. Is if you just do more complicated deals just for the fun of it, then you're not really creating so much additional value.
That's a very fair point. Very interesting.
Yeah, one con I would mention is clearly the inability of sector-focused fund to step out of the way, to be very opportunistic. If a deal could arise in an adjacent sector, but it's not fitting one-to-one with a set strategy, then there could be a missed opportunity. And certainly in line with what Paul said, the unwillingness to pay higher prices, although things may be aligned and a generalist fund may make a good deal out of a specific situation where sector specialists are oftentimes too knowledgeable and too cheap to pay for higher prices in specific companies.
Yeah, I think it's exactly that. You're beholden to the dynamics in your particular industry, and so we all know that capital is attracted to strong returns. So if you happen to be in a sector that has been very successful and the capital has flowed into that, you will find it harder, obviously, to transact at multiples that probably support similar underwriting to what you were making sort of 5 years ago. Look, I think from our experiences at Hermes, on the whole, sector specialism has been a good thing. But that's not to say that we haven't backed some very mediocre funds that were sector specialists, and similarly, some of our worst performing funds have actually been sector specialists. And a lot of it goes to the point that I was saying, where some of these funds you can find that there are quite concentrated risks, whether it's to a certain payer or regulator. So you sort of have to bear that in mind. And that can get quite messy in a 10-deal portfolio if, for example, a big piece of your revenue across the entire portfolio is tied to, say, one particular customer, one particular distribution channel, one particular payer. So there can be some inherent risks in the strategy that LPs need to be aware of.
Yeah, I can only echo that. I mean, what Cameron just said. I mean, if like there's a general pressure, for example, on the healthcare pricing or healthcare cost spending and so on, that is going to affect us no matter what. We wouldn't be able to do anything against it, basically, and simply step out then into another segment to invest. Another thing to add maybe is more privately, so to speak, for the GP professionals is obviously intellectually also very stimulating if you're looking at new sectors each and every time you're investing into a new potential portfolio company, which is not the case for us, right? I mean, we are not learning every time that we're investing, which is, I guess, good for our LPs, hopefully, and for the portfolio companies, but maybe less of exciting, stimulating each and every time you enter a new industry, right? So.
Yeah, so I have a question around sector convergence. Are we seeing, even within that sector specialization, people moving towards convergence? So where health tech might meet fintech in a way, and what's your perspective on that? Do you find that still an attractive space for people to still jump in and see what kind of magic could be made? So, the two of you coming together might be interesting. Would you like to give me some insight on that, Paul?
So we've seen some examples of this. So, for example, we looked at some opportunities which were a crossover between healthcare and either insurance or payments, like payments for healthcare, or we've been very active also in healthcare insurance in the various geographies. We've seen other examples in crossover between real estate and investment products, where, of course, you have investment products based on real estate or on alternative sources of energy. So we see these kind of crossovers, and it's always a question of seeing, is this more financial services, or are the risks and drivers more healthcare or energy or whatever? And it's not always easy to identify. Sometimes it's also a chance to arbitrage multiples, which might be different in different areas. So that's something that we look at. It's part of the strategy.
Yes,
Please
Sasha.
head to Summit Room 1 on level Riviera for the International Summit, North America. Thank you.
Well, thank you for that great announcement. That was relevant for everyone in here. I will move on with convergence. I just want to get your perspective, Sash, on that.
Yeah, maybe. I mean, we've looked at and invested into health tech companies where you actually see those convergences of tech investment, tech functionalities being provided into the healthcare space. But we've been a bit hesitant, simply because those the convergence we saw has a lot of hype behind it at the beginning, at least. You see a lot of extreme valuations in comparison to what we see in our cores. So that's something we consider very carefully and follow, but not necessarily invest right up. Yeah.
But Cameron and Pierre, then, from your perspective, would you find that more interesting if you started seeing more of the convergence and people playing within that sector convergence space? I'll give it to you, Pierre, first.
I mean, it's easier to answer, I guess, from our vantage point, since having a thematic approach enables you to consider several sectors. So the convergence of sectors is actually a good thing because it would fit within a similar theme. So not being very strict about how you consider a specific investment or fund manager in a specific silo enables you to have this I guess more open or be more open about how to define a specific sector. And the convergence, I wouldn't see it as a barrier to consider these types of transactions.
So very Swiss cheese-like, Okay.
Yeah, look, I think the only thing I'll add is I think the obvious driver of convergence is technology, which is obviously touching on so many sectors now.
Right.
And I think technology, however you define it, is something like 30% plus of buyout volumes now and growing significantly. It almost feels like most GPs now need to have some sort of ability to sort of read and apply technology within their portfolio companies. I think to the question about is convergence sort of good for LPs, just with my LP hat on, yes, but to Sasha's point, I think we always want to see GPs executing in their circle of competency. And so if they're sort of taking on a thesis that is very different from the sort of bread and butter that they've been delivering historically, then we would have to question that and sort of make sure that they had the resources and competencies internally to deliver on that.
Great. So I have one question before my final question, and that would be, so for any generalist firms that are out there, what would be your advice to weather the storm as people who love sector specialization? So maybe I'll start with you, Sash, in this particular climate.
Well, that's a tough one because I'm not in the shoes and have never been in the shoes of a sector agnostic fund. Difficult question. Let me think. I mean, it doesn't make sense to really then simply reallocate, so to speak, the whole strategy to a specific sector where there's less of an expertise. I mean, especially not something like the two of us, for example, do, just because there's like one or two deals that have been done in healthcare. Wouldn't qualify the fund to become a healthcare specialist, for example. So that's a tough one. I mean, what people do, what I've seen a lot is obviously they have teams within the sector agnostic fund that then specialize on specific segments. And I have no idea how successful that really is after all, because again, my understanding is they have to compete internally then for different types of assets in different industries and try to educate their colleagues about it, which sometimes can feel like an uphill battle as well. So it's hard, yeah. Maybe the idea is if you're big enough as a fund to have split funds that do focus then really 100% on that segment and that sector, and makes two smaller funds instead of one bigger one. That could be something, yeah.
Anyone else want to add to that?
I would just say it's very uncommon to see a generalist fund that has no sector specialization. So most larger GPs would have a specific angle of attack on specific sectors and teams that are more and more dedicated. So I think it's very difficult to find GPs that are fully diversified and that look at every sector. It could be the case for the transaction types, for turnaround funds or buy and build strategies that are perhaps a bit more agnostic on sectors. But any traditional buyout shop, in my view, would have some specialization on sector, and I think there's a clear convergence in that direction.
Right. Well, we have 5 minutes, and I always like to add a little spicy question. So because I'm African by origin, I'm going to ask an interesting question to our panel here, which is, if you could describe your organization as any African animal that you know, which one would it be, and why. And I allow the audience at the end of this to then call their organization by the animal that they have picked for their organization today, just for a little fun. So I'll start in the middle, seeing you have less time to think. So Pierre.
Well, our company logo is a lion, so I will have to go with the lion. That's an easy one.
And why a lion? A mighty roar?
The lion is probably one of the most symbolic and representative animal of Africa, but it symbolizes, I guess, some sovereignty and independence, I would say.
We have a lion here. Cameron?
I mean, I certainly didn't think I'd be getting asked this question when I came onto the panel. Off the top of my head, and going for something fairly obvious, I have to say an elephant.
I knew it.
You know, they obviously have very good memories, and I think we as an institution have been around for many decades, and there's a lot of grey hair at the senior level on the IC, and so I think that's very helpful when it comes to sort of navigating various cycles in today's environment.
Okay, we've got our lion here, strong, proud, and now we've got our elephant here, organizational memory. Sash, please.
Difficult one, maybe chimpanzees, if that works, because they are very, very, let's say, oriented towards their tribe, how to help them, how to work together as a team, if that makes any sense whatsoever.
Okay, so we've got the band of chimps right there, and Paul.
I would definitely say a hippo.
Oh. That's a good one, actually.
It's a hippo because hippo is a pretty underrated animal, I would say, often hidden. Yeah. And this, I guess, as a firm, we felt a bit sort of on the side for a while before we sort of proved our model. And it's a very dangerous animal at the same time. I think it's more people die from hippo attacks than any other animal in Africa. And so I think I would like to be a dangerous hippo.
Well, there we have it, ladies and gentlemen. We have our hippo, our lion, our elephant, and the band of chimps. So thank you very much for your time today. And yeah, thank you.